Hello, Finance 322. Welcome back. Hope you guys enjoyed your time off. Today, we're going to be covering Chapter 18. So hopefully you realize that this is out of order. We're going to do 18 and then go back to 16 and 17. This was done just in case we ran out of time and we had to cut some chapters out. Dr. Nazar, the one who created this course, actually felt that international aspects of financial management was more important than short-term financial planning and or working capital management. And so that's why we're doing it out of order. And so today what we're going to cover, as I said, is looking at finance from an international perspective. Right? So this is actually a really cool career pathway, all right, dealing with foreign currency exchange and being a financial manager for international corporations. And so I'm going to turn off my video so that I can write on the pad and share with you our PowerPoint and the website. So let me move this down so that it's easier to write on. And get out of here. And let me go ahead and share. All right, and so hopefully you can see this. So Chapter 18, as I said, deals with international aspects of financial management, which, as you'll see, there's a lot of them that a lot of the issues are the same, whether you're talking about international or nationally. And so there's not much difference. So the first part of this chapter really deals mostly with some definitional information, and then we're going to look into how exchange rates are quoted and what they mean, the difference between the spot and the forward rates, purchase power parity and interest rate parity, and the implications for changes in interest rates, and then the types of exchange rate risk and how it can be managed, and the impact of political risk on international business. And so, as I said, a lot of this is terminology. So, think about how these can be asked in multiple choice questions. American Deposit Receipt, or ADRs, okay, are securities issued in the United States representing shares of a foreign stock. And so, if you go to the U.S. Stock Exchange and you purchase a British business, that's basically what we're referring to here. All right, it can be traded in the United States. Now, before we had international accounting standards, right, those foreign companies used to have to convert all their financial statements into U.S. GAAP, right, in order to be traded on the U.S. Stock Exchange. That is not the case anymore. In the United States, you are allowed to use a recognized international GAAP or something that IFRS puts out for all you accounting majors. Another definition is this cross rate. All right, it's the implicit exchange rate between two countries when both are quoted in a third currency, which is usually the U.S. dollars. All right, and so that's kind of old these days because we have the power of the internet, right? And we're going to actually utilize that shortly. Then there's Euro bonds, right? A bond issued in multiple countries but denominated in the issuer's home currency. All right, and so again, we could purchase a French corporation's bonds, okay? But when they pay interest, they're not going to pay us in U.S. dollars. They're going to pay us in euros, all right? Because again, France uses the euro. Euro currency, all right, money deposited in a financial center outside of the country of the currency involved, all right. There's euro dollars, all right, the dollar denominated deposits in banks outside the U.S. banking system, all right. So again, mostly terminology. Something that's interesting, I had a friend that was in the Gulf Wars, and his unit actually recaptured one of Saddam Hussein's palaces, and in the basement they had pallets stacked with U.S. currency. All right, and so I think they've actually made movies out of this stuff. All right, but basically, in the United States, U.S. currency is one of the highest valued currencies out there. I mean, the euro and the US dollar are probably on the same threshold. But with countries that have rampant inflation, right? A lot, like I know that this happened down in Venezuela. Right? People wouldn't use the Venezuelan, I don't know if that's the right word, currency. They'd actually want to use US dollars because the value of the US dollar is more stable than the Venezuelan dollar. Right? There's gilts, is British and Irish government securities. Right? So again, these are things that you can invest internationally. There's the London Bank offer rate, or LIBOR, which is funny because a lot of times this is referred to as the LIBOR rate. Okay, but basically you're saying, the London Interbank offer rate. All right, so but the LIBOR basically is very similar to what the U.S. has. Okay, and it's when banks lend money to each other. All right, and so the rate international banks charge each other for loans of euro dollars overnight in the London market, frequently used as a benchmark rate for money market investments. Okay. We have swaps. All right, so we're going to look at different types. We have the interest rate swap, where two parties exchange a floating rate payment for a fixed rate. And then we have the currency swap, agreement to deliver one currency in exchange for another currency. These can actually be investments where you are buying, or you're basically gambling that things are going to change, and somebody's gambling that things are going to go the opposite way than you thought. Okay, and so they're actually derivatives. Okay, so if you've taken advanced accounting, and talked about derivatives, those would be examples of derivatives. Okay. Kind of switching the global capital markets, right? There are a number of exchanges in foreign countries, and they continue to grow on a regular basis. And really, what that allows is to be able to buy and sell both equity and debt securities around the world. All right, and being able to do it 24/7. All right, so. I think the U.S. stock market closes at like 3:30, but if you wanted to continue to trade securities, about 3:30 is the time that the Japanese stock market is starting to open up, and so you can continue to trade. All right, and so having a good capital market is really important, right, for developing countries, because it's a way that corporations can get money or capital. All right. So when we think about capital, we're talking about, hey, how are you going to finance your business, right? And there's two ways to finance your business: debt and equity. And again, that goes all the way back to our accounting equation: assets of the corporation equal the debt, all right, plus the equity. Okay. And so, if there's a country that is, developing, they need to be able to have a venue, right, to be able to buy and sell. Okay. And so there are differences between obviously different exchanges. The market structure is going to be different regulation, and then trading rules. All right. The U.S. is considered to be the most developed capital market in the world. All right. However, foreign markets are becoming more competitive, and often they're willing to, innovate more than what the U.S., because the U.S. is kind of the standard. All right, and so if you remember from your days taking economics, all right, when we talk about perfect competition, right, we always talk about the U.S. stock market. Why? Because we have many sellers, right, of stock, and we have many buyers. Okay, and that's what we refer to as perfect competition, right? That's the closest example we have to perfect competition. So think about going to Mexico for spring break. I wish I was leaving my house for spring break. Or Japan for summer vacation, right? How many pesos or yen can you get in exchange for your $1,000, right? And so there is a link here. I do want you to know that I actually clicked on that, and I got a whole bunch of warnings and things like that. So I might not click on that, But if you actually go ahead and type in, foreign currency exchange rate or something to that effect, you'll find one. And I'll show you the first one that popped up for me here in a moment. All right? And so when we're doing foreign currency trading, all right, the foreign currency exchange is considered to be the largest financial market in the world. All right, it trades, all right, 24/7 or around the clock. All right, and most trading is done in either U.S. dollars, all right, the pound, the yen, or the euro. All right, and so there's different ways. All right, we have the different ways these foreign currency exchanges are stated. There's the direct, right, which is the U.S. per the foreign currency, or the indirect, right, the U.S. or the foreign currency per the U.S. All right, and so let me stop sharing this with you, and I want to share something else. Okay, the website that I came to was I don't know, today.com. If we were in class, I'd actually show you my my cell phone actually has a what is it called? It's Units Plus. All right, so it's just an app that I downloaded, and it allows actually this has helped me out with my children. It actually is a conversion, so you can convert areas. Okay, you can do currency, you can do data, you can do mileage, length, power. Okay, and what I've been using it for is for my daughter with volume. All right, so how many ounces are in a gallon and whatnot. So it basically, it's it's free. Okay, you can get the pro version, but why pay for something when really it's pretty useful. And so I think the direct rate was talking about how is it's stated in U.S. dollars. And so here's an example, all right, where we have the amount. Okay, so I think we had $1,000, right? And so our $1,000, okay. Well, actually, no. The question was from U.S. dollars. Okay, so U.S. dollars to, I think it was euros, right? Or I can't remember. I know the one was yen, right? So yen. Okay. And so if we had $1,000, okay, U.S. dollars, that would convert into was it 107,609 yen. All right. And so what's great about these websites is that they're pretty close to the exact exchange rate at this given point in time. And so we could actually check back on this a little bit later and actually see how that is converted. All right. And so, a lot of what we're going to look at is actually going to, let me share, new share, go back to our PowerPoint. Okay. A lot of the, the steps that we're going to take for these exchanges, are kind of antiquated because now we have technology, all right? But we're still going to walk through this. And so, yeah, I think before we, how many pays or yen, okay, so we'd have that 100 and whatever million yen if we had $1,000. Okay. However, okay, that would be, I believe, the indirect, all right? It's the units of foreign currency, right? So what we just calculated there was the indirect, right? Because we're looking at, hey, how many yen, okay, the foreign currency per U.S. dollar, all right? And so if we had 1,000 U.S. dollars, right? Let me see, I can find that thing again. That converted into, 107,609. Yen. Okay. So, just understanding direct and indirect, again, will be a step that you'll need to be able to understand and be able to apply. Okay. And so, hang on. Okay. And so, before technology, I usually had to look these things up in the Wall Street Journal. Okay, one of the downsides of them, however, was the fact that, something that was published, all right, now this one was published way back, as you can see, in April 13th, all right, which is funny because today is April 13th, okay, but this was way back in 2012, all right, but it's showing you, here in US dollars or per US dollars, okay, and it shows the exchange rates. Where is the yen? Here's the Mexican peso. All right, but here's somewhere is the yen, Japanese yen. Not seeing it, but whatever. Middle East, Asia Pacific. It should be in here. Man, Japanese. Okay. So it has what's referred to, and we'll talk about this later, the spot rate. Okay. But then it also has the forward rates. Okay. And so we'll make that different. All right. Later. And so exchange rates, the price of one country's currency in terms of another. Okay, most currencies are quoted in terms of U.S. dollars, and so the direct quote, okay, the price of foreign currency expressed in the U.S. dollars. Okay, and so again, the direct quotation, right, versus the indirect, which is the amount of foreign currency, and this is what we actually calculated: the amount of foreign currency to buy $1 US. So it would probably be 107,000 or 107 yen to the dollar, or per US dollar, the indirect quote. And so, they just show us a US dollar to buy 1 unit. Okay, so here, if we're trying to do the euro, okay, the number of US dollars to buy 1 euro would be $1.32 with rounding. All right, with a Swedish krona, okay, it'd be 14 cents or 15 cents in order to buy 1 US krona. All right, so the direct quote, okay, is, as we said, is in US dollars. All right, and so a lot of times it refers that the euro is selling at this amount, which is kind of interesting because if we actually do go back, let me go back and share. New share. Okay. And I'm getting better at this. Okay. If we're going from, let's actually go from the euro to the US dollar. And just go back to 1. Okay. All right. To have 1 euro, okay, convert into US dollars is now almost, all right, it's $1.09. All right, so if you were going to buy 1 euro, all right, you'd have to spend $1.09, all right, to buy that 1 euro. All right, it's really close to a 1-for-1, which is pretty amazing, seeing that just a few years ago, to buy 1 euro, it was like $3. To buy 1 euro, you'd have to, have $3 US to buy 1 euro. And now it's almost a 1-for-1. And so hopefully you can realize the benefit, all right, of the US tourist now going over to, Europe and wanting to, spend money over there. All right. Our dollar is stronger against the euro than it used to be. All right? So we'll kind of look at that in a little bit too here. And so the indirect exchange rates, all right, so, units of foreign currency to buy US dollar. So all we'd have to do is flip that, the transaction that we had done. All right, so indirect quote is the financial currency per the US dollar. All right, and so, we could buy roughly 90, well, let's just do it. All right, so if we were to flip things, we'd say, hey, what is the, if we went US dollar to the euro, we could buy 92 roughly 0.92 euros. I don't know what the you know, if they call them pennies or whatever it is. But yeah, we're looking at the indirect rate here, okay, the US dollar into the euro. And so they're just showing you how you would use the indirect exchange rate, right, for that conversion. So direct and indirect exchange rate quotations. An indirect quotation is the reciprocal of the direct quotation. Oh, really? All right, so the direct quotation was 1 divided by the indirect quotation. All right, so euros and British pounds are normally quoted as direct quotes. Right? The pound is selling at US dollars. All other currency is usually quoted as indirect, all right, or the yen to the dollar. Okay, where this is the pound to the dollar, okay, that's the direct quote. Okay, where most other quotations are the yen to the dollar or the peso to the dollar, right, as quoted as indirect. And so here's an example. Suppose you have $10,000 based on the rates from the figure, that old exchange rate. How many Norwegian krona can you buy? All right, and so if they're selling for 5.7 krona to the dollar, okay, we're just going to take the the $10,000 multiplied times the exchange rate, and we could end up with $10,000. We could have 57,000 krona. However, if we're again, that was the indirect. However, if we're in London, all right, the exchange rate was 1.5961 dollars per pound. All right, we'd have to convert. Okay, I don't know why this is 1,000. Okay, 10,000 I think is what they're intending to do. All right. Oh, okay. No, they're basically they're taking this rate and multiplying it times 1,000. Oh, okay, yeah, this is 1,000 British pounds. I was looking up this here, all right, when I should look at the second scenario. Okay. And so that's how we end up with, in order to buy 1,000 British pounds, it's going to cost you $1,500 US. And so that brings us to this thing called cross rates. Now, again, this is a little bit antiquated because cross rates now you can actually generally find the conversion rate, right? But the cross rate is the exchange rate between any two currencies and not involving US dollars, all right? And so, if you're trying to look at the yen, and this would be ridiculous, all right, the yen to the euro, all right, you're going to be able to find that conversion, all right? But you can for sure find how yen go into dollars and then how dollars go into euros. All right? This is usually used when you have countries that aren't as active, all right, in the foreign currency exchange. But you basically run everything, right, or you base it on US dollar exchange rate. So here's an example, euros to Swedish krones, okay? We have the US dollar, right, and the to the euro, and we have the US dollar to the krona, or krona, hey, corona, the coronavirus. And basically what you can do, all right, the dollars eliminate themselves, right, and so you can convert, all right, the euro per krona, all right, and so you're just utilizing the U.S. exchange rate into the euros and krona to come up with the cross rate, all right, as such. Or you can, if you want to do kronas into yes, there should be an S there. All right. Okay. Yeah, that was not my doing. All right, that's just a typo. All right, but you can flip it the other way. All right, because in the beginning, remember, it's the inverse relationship. So the dollars cancel themselves out, and so you end up with kronos versus euro. Okay, being this amount here. That's the cross rate. Arbitrage, and yes, I had to look this up, the proper pronunciation of arbitrage. All right, it's the violation of the law of one price. Okay? And so hopefully you know what the law of one price means. It means all things being equal, right? The cost of a unit, or let's just say it's an apple, okay? The cost of an apple in the United States would be the same as the cost of an apple, the same apple, okay, in Russia. Okay. Now that may not necessarily be true, okay, but if we were to take the US dollar and convert it into, what is it, the ruble? I can't remember what Russia uses. All right, I think it is the ruble. If we converted it into the ruble, you know, it would be the same price, okay, that apple would be the same price. And so what they're actually saying is, hey, this is a violation, okay, of arbitrage, or not the arbitrage, this is the violation of the law of one price. Basically, if it's the same thing, you know, it should cost the same amount, all right, with all things being equal, all right, using the current foreign currency exchange rates. All right. And so arbitrage, all right, you can actually make money, all right, if you can find the violation. Okay. It's a positive cash flow with no risk, all right. And so we're going to look at triangle arbitrage. It moves through 3 exchange rates. Okay. And so we have some information. We have the quoted rates. Okay. We have 10 Mexico pesos, all right, per 1 US dollar. We have 2 Swedish francs, all right, per 1 US dollar. And we have the cross rate, okay, the peso to the Swiss franc. So the implied cross rate is 5 pesos per Swiss franc. All right. And so with this information, we can use 100 US dollars, all right, to buy pesos. And so using the foreign currency, all right, we end up, all right, and they made it easy, all right, so for 1 US dollar, all right, we end up with 1,000 pesos. We're going to take those pesos and we're going to buy the Swiss francs, okay, and so using that 4 pesos per Swiss franc, we're able to buy 250 Swiss francs. Well, we're going to take those 250 Swiss francs and then we're going to convert them, okay, into US dollars, right? And we end up with $125. We basically made $25 risk-free just by using the concept of arbitrage, all right, and the foreign currency exchange rates. So put it a different way, okay, you can basically, you know, kind of an accounting looking thing, all right, you had the $100, all right, so you subtracted your $100, all right, of US, okay, and you converted that into pesos, okay. Then you took those pesos and you purchased the Swiss francs, and then you took those Swiss francs and you purchased US dollars again, and you made your $25. This is what's referred to as triangle arbitrage. Sounds like a good multiple choice question to me. All right. So again, you know, this chapter is actually only going to be covered on the 6th exam. We do not have a comprehensive final exam, and so therefore, yeah, you don't even have to take this if you don't want. If you're happy with your grade after our exam from next week, you can literally just turn in your homework, all right, and you can be done with the semester in reality. However, I really encourage you guys to take the 6th exam because you can use that to replace one of the other exams that you might not have done so well. All right. So currency appreciation and depreciation, all right? Suppose the exchange rate goes from 8.919 kronas to the US dollar to 12 kronas per US dollar. What that really indicates, all right, and we kind of talked about this before when we talked about how the US dollar against the euro was getting stronger, okay? That's what's happening here. All right, the US dollar or the US is getting stronger. It's appreciating, okay, against the Coronas. And if that's the case, the Coronas is depreciation or weakening against the US dollar. Again, some terminology for transactions. We'd referred to this before, okay, when I was showing you that figure, all right, where when we looked at the yen, where we had the spot rate, and the spot rate is the exchange rate for an immediate trade or the current exchange rate. Whereas a forward rate, all right, is the exchange rate specified today in a forward contract to exchange currency at some future date. Right, normally reported as indirect quotations. All right, and so again, for those that might have been in advanced accounting, this is actually, we talked about this when we talk about, or I'm assuming you talked about this, when we talked about a derivative, all right? And so in intermediate, I did talk about this briefly, all right? But basically, here's the deal. You make a sale to Japan, all right, to a Japanese company. They're gonna pay you, all right, in yen, all right? And so when we recorded the sale, we're gonna have accounts receivable, all right, and we're gonna have sales. Because we're a US company, we record everything in US dollars. So I'm making up my exchange rates, right? But let's say that we make a sale, you know, when we made that sale, the exchange rate said, hey, we're gonna have $500,000 US. That looks more like an S than it does a 5. Right? Okay. And so we'd make the journal entry here. Okay. However, when they pay us, okay, they're going to pay us in yen. All right. And so, you know, and because foreign markets always change, the exchange rate is going to go up and down. And so if we actually took those yen that were paid to us, we would convert that into cash. All right, and let's say that it came out to be $504,000. Well, we would had our accounts receivable here. We recorded it, all right, for 500,000. Okay, and so what is this $4,000? Well, that's going to be a gain on foreign currency exchange. This is actually, for those that have had some accounting background, is part of other comprehensive income. Because we got more money, right? We got this gain, but it really wasn't because we did anything. It was because of the change in the foreign currencies, all right? And so we can actually lock in, all right, the exchange rate by using these forward contracts, all right? So let's just say this was, net 60, right? So we could buy a 60-day forward contract, all right, guaranteeing that we'd have a specific exchange rate sometime in the future. Because we may feel that, hey, just like this one went up, it is completely possible, okay, that the foreign currency, the US dollar, could be decreasing, which would mean we wouldn't get our 500. Maybe we only got 498 or something like that. So in order to alleviate that risk, what we do is we buy one of these future contracts and basically lock in a exchange rate for 60 days when we're actually supposed to receive that payment. And so with the forward rate, at a premium to the spot rate, okay, and so in some cases, all right, we're going to have differences. And so example, we have the spot rate, all right, this is the pounds to the US dollar, okay, whereas the forward rate, all right, basically says that, hey, the pound is expected to appreciate, okay, because, we're having to give less pounds, all right, to get the same dollar. The pound is expected to depreciate. If that's the case, then the US dollar is depreciating, right, or declining. The forward rate of the pound is what's referred to as a premium, right? Because we're looking at the pound, not the US dollar, okay? The forward rate is a premium. Guess what? If this was the opposite, okay, it would be the discount. And so, here they're the future is less than the spot rate, okay, it's going to sell at a discount. Right? And so they just show the opposite in this situation. Right? The pound is decreasing against the US dollar. Right? And so therefore the pound, not the US dollar, is at a discount. So the spot forward relationship, the primary determinant of the spot forward relationship is the relationship between the domestic and the foreign interest rates. Okay. And so absolute purchase price parity, again, the price at which an item is the same regardless of the currency used to purchase it. Okay. And so we talked about that the fair price of that apple. Okay. That's what purchase power parity is referred to it. Okay. It basically says that, hey, that the UK or the pound, okay, is the spot rate times, right, the price of US goods. Right. So requirements for absolute price or purchasing price parity, okay, there's got to be no transaction cost, no barriers to trade, right? So no tariffs, okay. So using that example of the apple, all right, we're assuming that Russia can grow the same exact apple, right, that the US can grow, right, and that there's no difference in that apple between a Russian apple and the US apple. So absolute purchase price parity, right, rarely holds true in practice, right? Because of these assumptions that we have above, right? No transaction, no barriers, all right, and no difference. All right. Usually only for uniform trade goods like grain, all right, things along that line. Okay. So relative purchase power parity quantifies inflation, all right, exchange rate relationship. All right, so it's really what we're trying to do here is we're trying to be able to anticipate, all right, a future rate, okay, based on inflation. All right, and what is inflation? It's the increase, all right, in price. So, if you were to buy, let's say, a box of cereal, okay, before this pandemic, right, that box of cereal costs us maybe, at Aldi's $1.39, okay, but now, okay, because our dollar, okay, because they've dropped all the interest rates, right, our dollar has gotten weaker, hasn't it? Okay, and so now it takes more dollars to buy that same box of cereal. And so it provides information, right? So there's relative purchase power parity, provides information about what causes changes in the exchange rate. And really it comes down to inflation, right? The exchange rate depends on relative inflation between the different countries. All right? Now, obviously this pandemic is worldwide, okay? So, some of the impact that is happening in the US, right, is also happening in Russia or wherever we're looking at, right? And so basically we have this equation. Right, the currency spot exchange rate, okay, this thing, the expected exchange rate at given point in time, okay, and so this is what we're trying to figure out here. Okay, we have the U.S. rate of inflation and then whatever the foreign currency. So we find the difference, okay, between the foreign currency and the U.S. Okay. We add 1 to that, okay, and we multiply that times the spot rate. And expected exchange rate at given number of periods, okay, so 30 days, 60 days, whatever. So that T and that T are the same thing. And so here's a given example. All right, we have a Canadian spot rate, okay, is $1.24 Canadian, all right, to the US dollar. The expected rate of inflation in the US is 3%. Okay? The expected Canadian inflation is 2%. Okay? Will the US appreciate or depreciate relative to the Canadian dollar? What do you think? And so we have a higher inflation rate than the Canadian do. Right? And so I believe the US dollar, all right, is going to depreciate against the Canadian dollar. Right? Why? Because our dollar is going to get weaker because of inflation. And so, since the inflation is higher in the U.S., we would expect the U.S. dollar to depreciate relative to the Canadian dollar. All right. And so, what is the expected exchange rate in 1 year? Okay, so again, it's just 1 year, 1 year. All right. We took the spot rate. It is currently this, okay, but it's moving because of inflation. It's moving to $1.23. Right. So U.S. dollar, $1 will buy less Canadian dollars, right, in a year from now. Why? Because of inflation. And so we're going to end. Well, let me see. We got 10 more slides. We're going to end it here, and then I will make another to finish up this chapter. All right. We're pretty much done with purchase power parity. And so let me go ahead and stop here.